Adem,
He's
how are you?
unmuted.
Yeah,
You guys able to hear me?
Oh, there
got
we
you
go.
now, Adem.
Great. There.
How
Hey,
are you?
how I'm doing good. How are you guys doing?
Good. Nice to have you back. Welcome back. And you're going to share your screen button.
Yes, I am.
And I think I saw a tweet by you today. You were talking about, well, what you wanted to talk about. I know that you were bullish uranium, and it finally really hit the news, the move in uranium. So, nice call. Nice call on
Yeah.
that, Adem.
Yeah, I got lucky on that.
Uh-oh.
Uranium was such a I'm actually skeptical of uranium going forward just because of the reflexivity of it and the I don't know, the market at this point, like energy, everything is so you know, volatile and high in price that it's hard to know what's genuine right now or just like speculative excess.
Yeah. Okay. So, is any of the supply chain constraints coming into your work? I know you look for contrarian things. I was just thinking if someone just mentioned here in chat. I'd say that consensus is it's going to be resolved, and I would say, contrarian what someone just said, that it's going to persist for longer than most people think. Where do you come down on that?
Well, it's tricky because even with, I mean, the entire global economy, since the 70s, we've been in an age of surpluses. You know, globalization, uh, basically air-conditioned and large haul shipping freight really changed the world ever since the 70s, 80s. And we haven't really seen the supply chain screech to a halt and then turn back on. So I genuinely think a lot of the inflation crowd is patting themselves on the back because they were wrong for a decade about predicting, like above trend inflation. But even if you had an economy pegged to gold, which, go back pre-1971, there were multiple periods where inflation broke out because of supply issues. That was the big problem, usually during wars in U.S. history, was that supplies would dry up really quickly relative to demand. Yeah. And since the 70s,
World War II, everyone turned into rubber, and
exactly.
They used wood on cars. That's how we came up with woodies, and so we saved everything and turned it into the war effort.
Exactly. And right now today we're seeing, not as an extreme of the war effort, but it's I don't see how there wouldn't have been inflation. And I remember last year talking with someone, I still think structural deflation is the plaguing of the world's problem more than inflation, because pretty much the two big drivers this year have been really, throttling markets have been energy and food. Well, the two big reasons those have really gone up in price so suddenly was because there have been really bad weather issues this year, and there was really bad supply side because of low prices. And the farmers were grains were getting killed up until recently because there were farmers dying because their soybeans and everything were so low price right before Trump left office. And then all of a sudden you had a total reorganization. You had China, after they dealt with their horrible African swine flu crisis, they had to restock their pork supply, which takes a lot of corn.
They've been stockpiling wheat for at least 5 years. So I mean, the grain side they've been stockpiling for quite some time.
Yeah, and they really stepped it up last year after they had to rebuild their entire hog supply. And so you have these factors that even if we were in a booming economy pegged to gold, I don't see how suddenly, having supplies globally get whacked wouldn't push prices up. So to me, it was never really a big question of like a little bit above trend inflation. Now,
Yeah.
that's
So it's
no,
not monetary inflation, it's supply shocks.
yeah. So yeah, like we've
Is
talked
that your
before.
point?
Yeah. There's the three types of the inflation: the demand side, supply side, and then the monetary. Throughout history, demand side has been that creeping inflation where you have like during periods of calm. Usually there was no wars. The men weren't going off and dying, times of no plague. So the people were living longer and they were having more children at a earlier age. Well, when you have like we were saying before, the 70s, usually, up until like 1000 AD recorded history, we've seen that there's been just, little price changes of 1% a year. But over 150 years, that 1% adds up. That's what? That's probably like 400% compounded increase in price. And when you get to a point, historically, there would be the rising prices. It's like when we go to the grocery store, we'll be like, hey, things have gotten expensive. Like, I remember a decade ago, I was able to get way more for 100. It's not like we're doing it every single year, noticing it losing 20% of its value. It's like a slow creep.
Yeah, invisible depression.
Yeah. And then, but the really tricky part with that is historically, there's been, once the creeping inflation built up, there would be periods of like a supply issue. So, in the medieval days, it was usually a crop failure,
Yeah,
just like bad weather. And then all of a sudden, it would send grain
pestilence. Yeah,
soaring. Yeah.
right.
And
Yeah.
then, population would usually, it would lead to revolts. Some of the largest empires collapse during, creeping inflation
Famines.
periods,
Yeah.
grain shortages, and then you'd have marginal fields go online, and then usually there would be like a big war, and there'd be a huge population decline, or the plague came in the 1300s, late 1300s, and then all of a sudden there was a huge period of deflation because you
Okay,
suddenly have
so
a
all we need now is like World War III and
yeah, unfortunately, yeah, that
to bring
so
down the population.
So the problem now is that if you look at the inflation, yeah, let me see if I can pull it up. I was just looking at this actually recently. The CPI, I think the chained the history of.
So
Okay.
besides okay, go ahead.
So
There.
basically, up until 20, you could see CPI was very volatile. And there's actually a lot of studies that the CPI has overstated inflation by 1% per annum since World War II. And that's because of biases, substitution bias, new quality bias, bundling bias. Like when you go to a supermarket and they just check the price of an egg, that's not,
Yeah.
accounting for like, when you go to like Safeway and it gives you, those coupon, monthly, you can save like $30 on groceries, or you get like or like a computer, you buy one computer product, you can get, Windows Office or whatever, you get all those like bundling products with it. So the CPI hasn't really been a good measure of inflation relative to quality. But even just using the CPI, we can see it was very volatile. Like, you have spurts of 15, 20%, like we were saying during periods of war, or in the
Yeah.
70s, when there was a lot of supply issues. Like a lot of the inflation in the 70s was the
Oil
oil
embargo.
embargo.
Yeah.
Exactly. And
Yeah.
and so even when we were on a gold standard, which there was monetary inflation, but the way monetary inflation amplifies demand side and supply side inflations is because you're putting more money in the economy. And when there's more money injected actually in the real economy, you're giving people more tickets to buy things. There's no more money for fewer goods. But what happened after the 70s that so there's a great book called Financial
Paul Volcker happened after the
yeah,
70s.
Paul
Yeah.
Volcker, and there's a great book that really it kind of puts it in perspective because it wasn't the dollar breaking from gold that really led to the inflation. The CPI in the US, like we already see, before we broke from gold, between 1960 to 1970, the CPI had already risen 90%. I mean, it was already a big increase, even while we were pegged to gold. And yes, the US was doing its guns and butter. But the point is, like, why is it back then the when the US had printed far less money and had even higher rates, was able to get more monetary inflation than post 2008 when they printed 4 trillion and they could barely keep it above 2%. Like if you look at the CPI, the average change in the CPI since the 80s, it's been mute. And it's been the longest, slowest decline. You know, it's known as like the second great deflation. The first one is the late 1800s, which like killed farmers and led
Yeah.
to like the big populist movement, you know, in the US. But now we're having a thing where we're unpegged, but inflation was going down. And the central banks, no matter what they could do, they really underestimated the age of globalization and they put their foot on the gas. And the byproduct of this, by them trying to stimulate inflation, because you know to make their debt cheaper, um, it, I mean, decrease debt in real terms. That's like the real big point of it. Is that it created tons of speculative bubbles. So the monetary inflation acts as like a very volatile gas on the supply and demand side. But ever since the 80s, like I was saying, there's this book called Capitalizing on Crisis by Greta Krippner. And basically her thesis, which is, you know, very profound, is basically saying the US governments, pretty much the world economies, made too many entitlement promises after World War II, but growth was slowing. So even before inflation was picking up, you know, there was stagflation. There was, you know, there was like recession, the slower growth in the before the 90s. It was like diminishing returns. Once we entered the third industrial revolution, which began in the 70s, um, there was diminishing returns, and we could see that in worker wages. You know, real worker wages compared to productivity, the bottom 90% of wages declined, and workers couldn't crystallize these gains as they could in the second industrial revolution because the high hanging fruit were gone. So we got to a point that the Fed, real incomes were declining before the break from gold and growth was slowing. So they had the easy solution: make debt cheaper. If an individual isn't going to be able to have his wages increase, then he should be able to borrow the difference. You know, the average family should go out, if they're, you know, if they're making less money, then they can, you know, use their credit card to buy goods. So they had to hyper financialize the entire economy. And that's what we saw after the 80s. But for them doing this, they created a huge savings glut with the top 1% because the 1% compounds their returns much faster than the average earnings have gone up. So you've had the richest 1% parking their money in banks, which kind of created a debt trap for the bottom 90% because because when you have so much money supply, yields go down. When the banks are loaded with money, yields go low. And that's the problem we've been seeing, regardless of what the Fed's done, was that yields have gone down globally because there's been a savings glut and a dearth of investment. And that's today what we're seeing in reverse repo. There's the banks are telling, basically QE, the QE is being nullified at this point because the banks are getting the money, the reserves, and then they're just sending it right back to the Fed. I mean, every night they're sending something 1.4 trillion back to the Fed every single night. A group of 70 to 90 banks, money markets,
So
funds,
what?
whatever.
Okay, so all right. So what's a contrarian play? Short energy, short gold. People that are buying inflation hedges. Is that your stance? Is that the contrarian play is to still bet
I
on
so yeah,
deflating arcs?
I personally think, back in April when yields hit like 1.78, I went
Yeah.
long bonds. I thought that was a great opportunity to go bonds and long dollar by short foreign
Okay.
currency, especially the short euro. I did just because I
Okay.
also did a short China thing, which worked out luckily because of the property sector. But this doesn't even include China right now, which is a
Really
basket case.
deflating. Yeah.
Yeah, and that's the real big thing that the mainstream. So
Okay.
a
I
lot of
wanted. I ask almost everyone I interview. I want your opinion. You're very. You've done a lot of research on this. So, back in 2008, in the great housing crash, Great Recession, the narrative was, well, China's still growing. They weren't as affected by toxic paper, and that their growth was going to help pull the world and the U.S. out of
yeah.
recession, right? So, we did. It was also, Fed action. So, the market can't have it both ways, and China's a much bigger percentage of GDP now than they were in 2008. So if they could pull us out of recession, can they pull us into one?
Oh, absolutely. And this is the thing about China. As this chart I have up, when you can see, up until 2008, China's main way for growth was exports. I mean, they were exporting some almost 40% of their GDP was exports. That's an insane number when you think about it. But after 2008, it crashed. Well, what happened? You can see in what picked up after 2008 was domestic credit from banks. So, like you were saying, China pre 2008 was dumping their excess onto the rest of the world. They were running huge surpluses, forcing the West to absorb it with their deficits. Germany does the same thing today. Today, Euro and China, they're both running surpluses, trying to eke out growth, forcing a deficit country like the US to absorb it. But what happened after 2008? The rest of the world said, hey, we're tapped out. We're up to our neck in debt. We have to deleverage. Well, China had 2 points: cut back exports, which would have made growth and unemployment rise. Growth would have fallen in their country, and unemployment would have risen. As factories had to turn off. But the CCP is very sensitive. Their promise that's always known as like that undercover promise between the CCP and their people. As long as they, give them their growth and a job, they kind of turn a blind side to the loss of freedoms, the more conservative state. That's kind of been their promise after the Tiananmen Square incident. And so China said, okay, we're going to, instead of depending on the rest of the world to absorb our excess, we're going to do our own building boom. And President Xi in China, and this went on for a decade, but in 2019, when this tightening, deleveraging pretty much started, because if you look at China's bond defaults, it rose shockingly. It's been new records each year, but it really rose in 2018-19. And President Xi came out and he said, listen, there's 2 types of growth that we've had. The high quality growth, which has been exports and productivity, services, the growth we want. And then on the other side, there's been low quality growth, which has basically been just malinvestment.
Both cities.
And go cities. And as China's high quality growth diminished, which it has everywhere else in the world, they ended up focusing more on low quality growth, like their provinces, to make up for the difference. I mean, to put it in perspective, China's incremental capital output ratio relative to GDP, meaning basically capital efficiency for each dollar they spend, how much they get, how much money they have to spend for each unit of growth. It averaged 3 for the decade before 2008. Well, up until recently, it's hit 11. So they're spending $11 now for half the growth they got. That's like walking. So that's 3 times the incremental output.
Is there a play in their currency, in the yuan here?
Well, so that's the big question. So like you were saying, now China has a huge low quality growth dependent economy, and Xi is he's very committed to trying to rebalance his economy. But that's going to come at a cost of growth, because real estate, it makes up about 30% of China's growth. China's real estate is about 3 times as big as US real estate market. And China alone between 2013 and 2018 drove 30% of global GDP. A lot of that came from commodities, which went to building these ghost cities. So as China deleverages, 70% of net assets of the average Chinese are in real estate, homes. Like, that's their value. So imagine when falling prices whacked the U.S.
Well, they already have. I've heard values are down 40-50%.
Oh, yeah.
Since Evergrande. Okay.
And they're going to go low. I don't see how they're not going to go lower as the China is forcing their property sector to deleverage. So not even accounting with the decline in household values, because China's real growth is investment, not consumption driven. But like you were saying, what happens going forward? There's 2 ways. Will China try to make up for their declining growth? Because China's total factor productivity has declined over the last decade, like the world's. Like, everywhere's looking for returns. You have a flood of money and a dearth of investment. Just economic returns have dried up, and China can't avoid that problem either. So, A, does China go back to trying to export, like dumping their goods on the rest of the world to make up for the growth, which is very deflationary by them dumping their excess abroad, because that by definition deflationary when when you have such big surpluses, you're dumping more on the world than you're consuming yourself. But you already have Germany and the euro and other Asian economies trying to squeak out their growth through exports. And now if China does it, they're going to have to cut the yuan to do it most likely, which will be very deflation. Like we saw in 2015 when they cut the yuan slightly, it sent world into almost a deflationary shock. Or the second solution is, does China empower their consumer, increase wages at home,
To
and
sop it up.
exactly, so they become the marginal growth engine, I mean the consumer in the world. So I personally don't see them doing the second option, because China has repressed, they have very harsh, like compared to America, the consumer is very repressed in China, and in most fast, high growth, export driven economies follow that route. Like we saw it in the Soviet Union, we saw it in Japan. They focused on forcing their consumers to save. So then the banks, to spend less. So when you spend less, you're saving the difference. And when you have, in economic theory, savings equals investment. So when you have all that money in the banks, the state can come out and take easy funding to deploy where they want. So either China allows their consumer to start spending those savings, going into debt to fuel the rest of the world. That would be very inflationary, I'd imagine, because all of a sudden you have a population of 1 billion plus, 3 times the US, gobbling up whatever they can. Or you're going to have that economy, because China has a spending problem. Asia has a spending problem. They don't spend as much. And that's what the Western economies have been begging them to do for the last decade and, decade plus. But we haven't seen it.
Okay, and we do the opposite because of financial repression, that it doesn't pay to save. So they must get a little bit of a yield over there. Let me ask you this. I think you're still on what I'm reading, still on the deflation bandwagon. One more swoosh, maybe, right, Adem?
Yeah.
Okay, with your narrative right now, and I know I'm not a premium subscriber, but I've given you some visibility here.
I appreciate it. Thank you.
What's actionable with your thesis and narrative going forward, say into the end of the year? What are you looking to do?
So yeah, I made a pretty penny with uranium this year.
Right.
That's old. We did the yield. I still like anytime.
And if it's nothing, that's fine too. I mean, there are times that maybe you don't see anything.
Yeah.
You're just so are we there?
Right now, I'm shorting commodities, base metals, because I'm like locking in long-term optionality, like uranium. I would rather find overvalued, like a Vale or, etc. These over leveraged miners that are very dependent on, commodities, China's demand, maybe, the Australian currency, etc. Like I'm looking at locking in long-term optionality that, long dated out of the money puts on these, that if I'm wrong, in a year from now, it won't hurt me. I lose, a couple thousand. But like in uranium, if you're right, that couple thousand can return, 20-fold. And it makes up for those returns. That's why having optionality in this market is important, but never selling it. Obviously, you don't want to sell options and get your head blown off if the trade, because markets are going to be volatile. I think inflation is going to even like, when I talk about like deflation, I just talk about structural deflation. I've written tons about inflation up until 2018. I was a big, inflation's going to eat away at everything. It's going to erode. But then I really learned the difference between asset inflation, which is a side effect of the Fed's policies,
right?
Which is having to financialize the economy to make
up for the
loss of income. There is no
other alternative. Forcing people to take risk.
Exactly. There is no, like, the Fed can't, like, they obviously see this housing bubble here. They know it's
a shortage.
There. Exactly. It's a shortage. And if you actually look at so that leads to another thing in the US. There has been a horrible concentration of sectors, meaning like oligopolies. This chart I have, look at the decline of antitrust enforcement in the U.S. It's pretty much disappeared since the 80s.
Yeah.
So you're having, and then you had a M&A wave, mergers and acquisition. I wrote about this recently on my site, but there's been like a cartelization of U.S. and it has all the symptoms. It has above trend profits, declining net investment, higher artificial prices, squeezed wages, lower productivity. These are all the signs of an oligopoly. And if you look at it in the US, two major beer companies control 90% of the beer market.
Yeah.
80% of US households only have one or less option of like a modem, like,
Yeah.
internet provider. And
Yeah.
we've gotten to a point where we have less freedoms. And when you have
Right.
a monopoly, the DOJ pretty much gave up on, the revolving door between governments and, the private sector has gotten,
And now
revolved
they're
faster
coming
and
back.
faster.
Do they have the wrong target with Facebook and Google?
It's
And
too late. It's at this point, like
Yeah.
it's jawboning in my opinion, because if you
All
look
right.
at how many people left Google that worked in Obama's office, it was tons of them. In the Bush administration, there went from over 100 defense contractors in the 90s to now there's just 9 that are the most powerful. Like everything is consolidated. If you
Yeah.
look at new public firms, the amount of public stocks in the indexes fell from a peak of 8,000 in the late 90s. It fell in half today. So we're seeing big companies get bigger by absorbing competition, and then they're raising. Then the lobby dollars have exploded because these firms are lobbying to erect barriers of entry, which prevents competition. And when you don't have competition, you have declining wages, declining net investment, lower productivity, squeezed wages, and all that other nasty stuff. So
Yeah.
that's another problem that is leading to inflation, because they're restricting supply on purpose to keep their margins artificial. So we do have inflation problem, rising price problem in this country for sure, but it's not monetary, because monetary, if you look at bank loans and leases, like how much banks have to lend money to create money in our modern financial system. And bank lending has declined like very bad compared over the last 4 decades. And it's like what we were saying, since the 1970s, we can't escape diminishing and economic returns just falling lower. It's a global problem. What China does going forward will probably be very important, but yeah, I don't see them suddenly unleashing their consumer to change, or it won't happen that fast, because the power elites who got rich off exports and infrastructure are already in place. So historically, it's come in a very nasty fight when there's a big rebalancing like we saw in Japan.
Okay. So Adem looking for China would help Adem's position if China kept dumping commodities. So thank you so much. Okay. So here's your website.
Oh yeah, this is just my website if anyone's interested catching up
Okay.
with whatever
What's the
content I put out.
address?
Speculatorsanonymous.com, and then
Okay.
my Twitter handle is just at Radical Adam.
Okay. And you also have a premium for getting your calls and your trades.
Yeah, for
Okay.
plays and book notes, packets, all that stuff. I usually
Yeah.
just do book reviews because people don't have
Right.
the time
The-
to
the-
read an 800
No,
page
they're just
economic
lazy.
book.
They're
Yeah,
lazy.
it can be pretty
You
dry.
could be nice and say they don't have time. They have time. They're just lazy. So anyway, I hope you have a great fall trading season, or your optionalities blow up in your favor, Adem. And I really appreciate you coming here and sharing your. You're one of the smartest guys I know for such a young age. I'm always look forward to talking to you.
Yeah, I definitely appreciate it, Dale. Thanks for having me on.
All right. So my trading warrior brother, Adem Tumerkan, and you could find him. Show the website one more time, Adem, so when people look at the video, they could see it and know how to find it. And do you have any kind of newsletter that you put out on this too?
Yeah, so
Articles?
yeah, I just do articles and stuff, and I also have a reading list on my site for anyone who's
Okay.
interested. I know
For
it's
all
hard
the
to find
unlazy people that might
all
actually
these
sit down
books.
I was
Yeah,
reading a book Friday. You know why?
why?
My internet went down and
Oh
cable went
wow.
down. Yeah, so I was
Yeah,
forced to read.
I try to
Anyway,
read. I try to read a couple hours every night, but I'm a slow
yeah,
reader because I write notes. It helps me remember better, but it
yeah.
makes things very slow.
All right. Well, I appreciate you starting off our week, Adem, and uh, you know, I'm going to be keeping an eye. I'm going to start charting uranium and see if I see anything there as well. So I appreciate you sharing your work with us today.
Great, thanks, Dale.
All right, that's a wrap, everyone. Remember, don't just count your optionality, count your blessings. We'll see everyone for Turnaround Tuesday. Adios, and follow Adem at Radical Adem and on Twitter, and you have his website address. Check him out. Adios.